With the failure of Silicon Valley Bank, Signature Bank, and with other regional banks teetering on the brink of bankruptcy, you may be asking yourself if life insurance companies face similar threats of insolvency. Are the companies that issue your annuities and cash value life insurance policies in danger of similar runs that would force them to liquidate assets at a loss, thereby endangering your insurance contracts? To understand whether or not life insurance companies are facing similar dangers, you have to understand why banks have been failing in the first place. In the case of Silicon Valley Bank, rising interest rates caused the value of their long-term treasury bonds to fall. And when they sold these bonds off, it triggered alarm bells among SVB's depositors. After all, why would they willingly incur a $2 billion loss if everything was rosy? This seemed like the move of a bank in the throes of insolvency. And so depositors began demanding their deposits en masse. Within a few days, this contagion had spread to other regional banks until the Fed finally stepped in to staunch the bleeding. So, given what we know about the failure of SVB, could this contagion spread to life insurance companies as well? Is the money in your cash value life insurance or annuities really safe? The short answer is this type of contagion is not likely to affect life insurance companies. And there are several very good reasons why. By the way, a big thanks to Bobby Samuelson over at Life Product Review for the insights here. First, although insurance companies do hold long-term bonds in their investment portfolio, just like banks do, they aren't likely to realize losses should those bonds decline in value. Unlike bank deposits, you see, life insurance and annuity products are far less liquid and are not understood to be short-term investments. The general account assets that back these products can't simply be wired into your bank account at the drop of a hat. In fact, many products these days are even less liquid than in the past. This is primarily due to contracts that have guarantees contingent upon lifetime premiums, guaranteed income, or even guaranteed long-term care benefits. When you take ill-timed distributions from these products, you could potentially void the guarantees. So consumers are loath to do so. It's typically their very last resort when they need to access immediate cash. If surrendered, these contracts could actually produce a gain for the insurer because of the release of the reserves required to back those guarantees. Next, outright surrender of these life and annuity products could potentially produce a taxable gain at ordinary income tax rates for policyholders, and in some cases include penalties. If consumers were to move money out of these products, it would most likely be by way of a 1035 exchange. However, in the case of life insurance policies, you'd also face new underwriting. And if you've had some sort of health issue since your policy got issued, you may not be able to qualify for a new one. In the case of annuities, you might have a guaranteed income benefit that couldn't be reproduced in today's economic environment. Next, you also have to understand what triggered the run on SVB and other regional banks to begin with. Social media, as it turns out, was a huge factor. According to the Wall Street Journal, social media, which hadn't been a factor during the last banking crisis, pinged both fact and fiction around the world at lightning speed. Spook customers whipped out their phones and opened their banking apps. With a few taps and swipes, their money was on its way. Close quote. Furthermore, Silicon Valley Bank had relatively few customers, and those customers had massive balances above the FDIC threshold. So if just a couple of people get spooked as a result of this frenzy on social media, things can go south in a hurry. Life and annuity companies, conversely, have products owned by hundreds of thousands of smaller customers who are less likely to stampede towards the exit all at the same time. And even if they did want to withdraw their money, it's not a digitally driven, lightning fast process. It tends to involve a lot of paper. There isn't a transfer button to push on a mobile app that will zing money out of your cash value life insurance policy and into your bank account, for example. Lastly, insurance companies have incoming customer premiums that flow consistently into their general portfolio that in normal times will provide them with 4 to 5 times the cash needed to cover any policy surrenders. Unlike banks, the insurance products themselves create the liquidity that allows carriers to hold long-term bonds to maturity. If you want to learn more about how to incorporate cash value life insurance and annuities into a balanced, comprehensive approach to tax-free retirement, be sure to check out my tax-free toolkit. You can download it for free at taxfreetoolkit.com. If you're a financial professional and want to learn how to become a certified Power Zero advisor, head over to powerzero.com and opt into my free 3-part video series. By the way, if you have any comments or questions, feel free to drop them into the comment section below. I respond to every single one of them personally, and don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.